Oh, I'm muted. Hello. Good morning. Welcome back to another compliance catch up. Seems like ages since the last one. Anyway, today I have just the most serious industry practitioner. Depth of knowledge, outstanding. This is going to be a really good chat. Let me introduce Josh Deeks from the Edmund Group. Josh, welcome. Hello.
Thanks, James. Hey, welcome, everybody. Good to see you all here.
So, Josh, everybody knows who I am, hopefully. If you don't know who I am, in the description later on. Josh, why don't you introduce yourself and tell us how you've got to where you've got to?
Yeah, so hi, everybody. I'm Josh, founder and CEO of Edmund. This is a consulting company that's been running for around 3 years or so now, but prior to this, I had a background working in banking, retail, consumer credit, more traditional spaces, and also building and launching fintechs in the UK. My background and experience is primarily focused in compliance, regulation, risk management, and financial crime. And for the last 3 years or so ago now, I've been advising all different types of fintechs and banks to help them with their regulatory issues.
And the Edmund Group, 3 years old, growth path, how did it come into being? When did you decide you wanted to hop into the advice channel, and how's it going?
Yeah, so I've been working with my co-founder actually on the other side as an employee of banks and fintechs for quite a few years. We'd noticed similar challenges popping up for other fintechs as well. So we were talking to heads of compliance, chief compliance officers, and they were relating very similar challenges to the ones that we were experiencing. So we started to ask ourselves why that would be the case. And we actually started to look outwards towards the advisory channels to understand, okay, why aren't people getting the strength and depth of advice that they need? And we decided actually, from our own experience, having worked with a number of the major consulting players, oftentimes it was incredibly expensive. And so money and budget was always an issue. Typically, because we were doing quite innovative and forward-thinking things, they didn't necessarily understand or apply their knowledge and experience to our specific situation. And so it wasn't as tailored as we thought it was. And oftentimes, when you're working in a rapidly scaling environment, you're having to move very, very quickly. Traditional consulting doesn't really keep pace with you. So we wanted to build something different that achieves those three objectives. And that's what we set out to do 3 years or so ago. We've grown organically entirely for these 3 years. So by word of mouth, we've been testing how our services are deployed, how our clients are getting the very best from what we're trying to do. And now we think we're in a very good position for what we've built, and we're going out now to start scaling and growing faster, basically.
What does your typical engagement look like with the client? How do they become introduced? How do you develop them? Typically, what services are you offering them?
Yeah, so the development piece is very, very easy because we've grown all by word of mouth. So somebody who we know directly and has worked with us on the professional capacity before believes in our knowledge and trusts us to get the work done. We grow that way, and we also grow through recommendations. So somebody who knows somebody, typically what you might know as second-degree connections, let's say, to use some LinkedIn terminology. So we've grown entirely that way for the last 3 years or so ago. Last year, we actually acquired a company called Medius Consulting, which is now a wholly owned subsidiary of Edmund. So, of course, we started working with a whole group of new clients through that acquisition. And we also purchased the client book from another consultancy as well. So similar sort of thing. We got a bunch of new clients that way. Typical engagement is probably atypical, I would say. We actually set out to help fintechs almost entirely, and we set up our business model to do that so that we could.
Oh, and he's gone. I wonder where he's gone to. There'll be a slight pause while Josh puts himself back onto the internet, and we will find out. Oh, there he is.
Apologies.
Hello.
Apologies. Right in the flow.
As entertainment.
My Wi-Fi switched over bands, it seems there. So sorry about that. So yeah, we were just talking about what the typical engagement looks like, and really it's atypical. We thought we were going to serve fintechs pretty much exclusively, and what we've actually done is we've served household names, some of the biggest brands in the world. We have served a lot of fintechs through regulatory application journeys and through remediations, but no one client has been the same. And I suppose when I think back to my time as a head of compliance, and we had a hypothesis that consultancies weren't really serving this group the best way that they could. We said all of them have quite individual needs. And so I guess what we're seeing is the reality of that.
Mm-hmm. And how are you differentiating yourself against the big name consultants? Because obviously fintechs get your investment, spunk a whole load of cash on brand names, everything's good. I paraphrase the model. How are you coming up against the big four and differentiating?
Yeah, so our experience in the past is that it's always been very expensive to work with them, incredibly high day rates. Usually what we've experienced is that the work takes quite a lot of time to be done. And oftentimes we're paying for certain levels of seniority, and what actually turned up at the door was people that were not senior at all, in fact, and really didn't understand our business model. So as a head of compliance, I was teaching them my environment before I could get any kind of value from them. And in a way, it felt like I was paying for their own training and development. What Edmund does differently is that we hire exclusively from people who have been money laundering reporting officers, chief compliance officers, specifically in the spaces that we serve. And so what that means is if we're dealing with financial crime issues and consumer credit, the experts on the team providing those services will all have been financial crime experts in consumer credit for a bank, for a retail institution. And so, we're ready and willing on day one to get our sleeves rolled up and get on with the work. What that also means is that our advisory service is much more than advisory, really. It's much more operational in nature. And so we're not just explaining what best practices look like and what you should aim for to be in the FCA's good graces, let's say. We're also really on the ground delivering work day to day. We're building documents internally, working with stakeholders, managing process flows. And so that experience feels quite a lot different than what you would normally expect.
And what would you say are the key differences between a fintech and a traditional finance company? Where are you seeing the expertise coming into play that you bring to the table clearly that maybe the big four don't, because they're used to the more traditional type players? Well, where is that delta?
So more often than not, the common ground between those situations is that the retail institutions really have so much on, they're looking for us to support with capacity. So it's not necessarily that they don't have the expertise in-house to deliver what they're asking us to deliver. It's just that everybody is so stretched that they can't get to a particular piece of work. Now, what we find interesting for those groups, of course, is that oftentimes there's a lot going on. So you're dealing with a large group of stakeholders. You're trying to make sure that the work you're doing gets through all the right people at the right time. With fintechs, of course, it typically is a much smaller environment. So the communication element is easier, but the fintech is trying to move very, very fast. Of course, they have investors that they need to please, and so certain milestones need to be hit. And of course, if those milestones are not hit for fintechs, then it actually is an existential threat because they're burning through cash up and until the next funding round. So you can communicate quite well. We often find it's a bit more educational in nature for the fintechs as well. We're doing a bit more of the teaching and development for their own technical knowledge. And so you do get a bit more of the why do we have to do this type of question, and we have to explain and educate what those reasons are. But ultimately, the pressure is probably higher with fintechs because they are trying to move fast. They have expectations that you will move fast with them. And I think that's reasonable. That's a reasonable expectation. They would expect it of an employee, and so they should expect it of their professional services providers too.
And my mental model of an entrepreneur is somebody that's happy with a crazy risk loading. Most entrepreneurs I know are just surfing along on risk levels that most people would shrivel up and die with. It'd just be too much for them. How does that play into a formal regulatory framework? You've got crazy risk takers betting the farm on a certain way of doing stuff, and the regulator saying, sorry, CISC, MAR, COND, there's the rules. How are you arbitrating between the two positions?
Well, I think there's a term that's been around for a long time in compliance called compliance enablement rather than compliance blocking. And I think it's a wishy-washy term that's kind of thrown around. Nobody really knows what exactly that means. But, if we've got clients who are genuinely entrepreneurial in nature and want to take high risk, we need to make sure that they're well controlled and that the work that we're doing isn't tripping them up or slowing them down. And if it is doing so, that they're very clear on why it's important that that happens. And so sometimes there is, again, back to this piece of education around why it's important not necessarily to grow at any and all costs. Sometimes it's important to put in the controls before you do so. But the good thing is that there are myriad experiences that we can give to those particular clients that we've dealt with in the past, where we can say, look, we've worked with these clients before, we've seen this play before, and usually what happens is you grow very fast until you run smack back into a regulatory wall, 25% of the way through your corporate plan, and suddenly you can't grow anymore because the FCA have stopped you growing. And so the message you're then giving to your investors is one entirely different than the one you'd hope. And do you really want to risk all of that for what might be an additional 2 months or 3 months, let's say, of work? And so it is much more about having an open conversation, an open dialect, and trying to explain the risks and the benefits of doing things. But that being said, we're a small, agile team. We work very fast as well. We deliver fast. Our team are very often online past midnight to help clients. We do that at no additional cost. We just do it because we know that that's what they need and we're their partners. And so, we try not to give any reason to be seen as these compliance blockers, but much more we are a trusted partner. And if we're telling somebody that it takes a particular amount of time, we're not doing that lightly because it's convenient for us.
The whole ethos of the entrepreneur, move fast, break things, it's all about finding clever hacks to give people time back, give people money back, etc., because effectively reinventing banking isn't ever going to happen, right? Everybody's got a credit card and a bank account and this, that, and the other. So fintech to me is a clever edge case where you're inventing some new way of doing things. You're rounding up the money and putting it into a savings account, or you found a new way of offering advice. By its very nature, regulation is quite slow. It's considered, it's provided by the regulator, who's always fighting the war before last. I think they're probably thinking the Napoleonic War at the moment is a good lesson, given the FCA. But inherently, the regulations are there and monolithic, whereas the entrepreneurs you're dealing with are always trying to find a new way of doing things. How do you arbitrate between that monolith and the clever hacks that your fintechs are coming up with?
Yeah, it's a great question. I mean, it's actually what inspired me to get into fintech in the first place, way back before I started Edmund, because ultimately I'd had and owned my compliance and regulatory skills within traditional environments. And I wanted to be challenged by entrepreneurs to think outside of the box and try to understand how the existing regulations apply to something that feels entirely different. So it's what excited me actually about making that change into fintech when I was much more junior. These days, I think it is a really challenging point, I would say, because we do have some clients that are at the very forefront of financial services. They are candidates for the FCA's innovation pathway, the sandbox, etc. And in those situations, it is really difficult because what they're doing is really different than what's been done in the past. Can you hear my dogs?
Your emotional support dog has just heard the FCA trigger word and is now barking.
Yeah, exactly. I've trained them well, haven't I?
Yeah.
It's been it's a great distraction. But no, I would say that for those candidates where they're doing something really very different to how the rules currently apply, you do have to work alongside the FCA. You won't always get, for example, a black and white answer of yes, this is okay, or no, that's not okay, as you'd expect. The FCA do not do that. But it's really on us as the professional services firm to interpret what the requirements say, what the FCA have said in terms of guidance, and what our client wants to do. And so a good example is that we're working with a company right now who have a very disruptive idea in the mortgages space, and how the regulatory handbook of MCOB applies to his business model is a very complex thing. So that is a challenging intellectual exercise, and of course, where it becomes risky for us as a company is if we get that interpretation wrong, we're in a lot of trouble ourselves, right? So yeah, it's a difficult line to tread, I would say.
And I think it's fair to say that the market's view of the FCA is it depends on which resource at the FCA you get, and their recruitment is patchy. Are you finding that you're desperately hoping to get the person in the FCA that understands? Because if you don't, you know you're dead. Or is the FCA as a body flexible enough to understand that you do need a certain skill set to interface against you?
It is a little bit with bated breath, to be honest. When you put in an application and you know that your case is about to be reviewed, you do hold your breath for the best people that are available at the FCA. You know you're going to come under more scrutiny, of course, because they're better at finding those loose threads to pick at and see if there really is any risks that the regulator need to be aware of. However, you do hope for that person, to be honest. The FCA, much like any organization, it's not resourced perfectly across the entirety of the business. They do use some resources that are underskilled in some areas, but there's also an argument to say they need to develop people, so how best than to put them in real life situations. But we have also had many cases where your counterpart on the other side perhaps clearly doesn't understand what you're trying to do. They ask the same question multiple times, trying to understand your answers that you gave the first 3 times. And so in those cases, it's really difficult because, of course, the entire time you're burning cash to build the business. And a lot of times you're at the mercy of your case officer, really, to make some form of decision to move your case onwards. So it's definitely a challenge that comes up a lot. And of course, we have had instances as well where the FCA's ability to retain staff causes a lot of friction for an application journey. So we'd helped one client, for example, and the case officer changed 3 times during the course of the application. And that is not uncommon. And I know that there are people out there that would have had that happen many more than 3 times as well. And of course, each time that changes, you're re-explaining yourself. It's a whole set of new questions. You're essentially going back to square one for all intents and purposes for the review process.
And how do you think it can get better? Obviously, the FCA's tried with the sandboxing innovation pathway, all of which seem to be populated with really big, well-funded organizations rather than thrusting entrepreneurial startups. But maybe I've misunderstood the purpose of those 2 vehicles. How do you find that works for you over and above the traditional FCA pathways?
Yeah, it sounded like there was 2 questions there in terms of 1, how can it get better, and then 2, what has been our experience with the regulatory sandbox and innovation pathway. On the 1, I think the effort needs to be both sides. So on the FCA side, hiring better people, maintaining the skills that they have, and retaining the good people, listening to feedback from the applicants around what the experience has been like, and where they've done well, where they haven't done so well. On the private side, though, I think it is also important not just to chuck in crap, frankly. It is very hard when all you're seeing all the time is people who are supposed to be coming to you ready, prepared, willing, organized, and have their affairs in order. And actually what they've done is cobbled together a business plan, chucked it in, and hoped that will pass the bar. And of course, it doesn't. It just wastes the time of the FCA. So I think there's an obligation on both parts. And of course, where Edmund is concerned, we make sure that our part is done well, and the application is all up to date. In terms of sandbox and pathway, the innovation pathway, I think it works quite well. We've had actually fairly recently, we were talking to another fintech that had been through that pathway and had an incredible experience. They had all the guidance they needed. They had been able to ask questions about their interpretations and their deployment of operations and processes. And the FCA hadn't really given the green light, but they had showed strong support of what they were doing, enough to be confident that they were moving the right way. Our experience is slightly different. The FCA is generally less committal on that. But I think when you're part of Sandbox Innovation Pathway, you definitely get more support than the traditional application journey when you're going just through the standard route, let's say.
And do you think that it's fit for purpose for fintech? Because we hear a lot from the government, the economists about productivity and the rest of it, and how innovation is the core of how we drag ourselves out of our current economic malaise. Do you think that the regulator is in line with that journey and is improving, or is it just not fit for purpose for what you're trying to achieve?
Well, it's not really big enough or fast enough, probably would be, my answer. Again, you've got a lot of businesses trying to do disruptive things in financial services starting every single day. It's slowed down a little bit at the moment because VC funding for a while, the taps were off, or at least certainly not flowing as fast as they had been in the past. The taps seem to be opening again, so the volume of new fintechs coming to market will creep up again. We've got everybody and their wife trying to do something with AI because it's the hot new topic, and I imagine we'll touch on that later in the session. But certainly the volume of people who would want to go through Sandbox and innovation is much higher than the FCA can cope with. But again, it's a difficult one to tread because they don't have unlimited money. So how much would they or should they deploy into that particular element? I'm not so sure. And of course, we talked a minute ago about people who put in applications which are not well thought out, not particularly well controlled. My opinion would be that that's even more inherent in the fintech disruptor space. Oftentimes you are finding people who have never worked in financial services before having a go, let's say. And so I would say that the Sandbox and the innovation pathway are inherently more challenged by that same issue.
And the big thematics that have happened, the SM&CR and customer duty as the big marquee activities of the FCA in retail and governance, how did they come across to the entrepreneurial classes that you deal with?
Well, we've had all kinds of conversations with new market entrants about what it means to be an SMF approved person and what the process can look like. We've also had people coming to us in desperation, really, because they've been underserved by others and they haven't communicated the same messages that we have. So, for example, if a client of ours is putting themselves forwards to be an SMF approved individual, particularly for the control functions of compliance or money laundering reporting officer, it's not uncommon to have a small co-founding team saying that, we'll just put ourselves forwards as MLRO or as SMF 16. And of course, the FCA will take a look at that and they'll be thoroughly concerned about the experience to hold that accountability. So we advise our clients that it's not the smart thing to do. The best thing to do is to deploy the capital into somebody who's been there and done it before and can talk to the FCA, because you shouldn't assume that you'll just get a pass. You won't just get a pass. And we had somebody come to us maybe a year or so ago now saying that he'd been advised he could put himself forward as chief exec, as SMF 16, as SMF 17, and it would just be fine. Don't worry about it. He was hauled into the FCA offices for some very technical interviews for something around 6 hours, unrelentingly asking technical questions about the chief compliance officer role, the money laundering reporting officer role, the compliance oversight function itself as an accountability, and what he knew about those things. And of course, he had no answers for them because it wasn't his background. Now, they didn't let him off the hook. They just continued to ask questions, probably to labour the point that it was a stupid decision. But unfortunately, that was the product of external advice. So, I guess we do things differently there. And on the point of consumer duty, it's an interesting one because it's not a new topic anymore. It's been around for quite some time, but we are still talking to firms day to day who are very behind the curve. They're not close to being ready for consumer duty. The FCA are starting to, of course, probe and ask questions now about firms' implementations of consumer duty and what they're doing on a day-to-day basis. A problem that comes up frequently and has been coming up a little bit more often is the point of fair value. A lot of companies are now resting on the laurels that they've done some benchmarking, and that's how they've assumed fair value. We've got a bit of a traditional regulatory challenge in the sense that the FCA is now telling firms that's not good enough, but they're not telling them what is good enough, and kind of figure out yourself what else you should be doing for fair value. But we're still finding firms who haven't actually implemented much at all. So we're helping them to get ready for consumer duty now.
I'm assuming, obviously, most of the fintechs are retail focused rather than wholesale focused.
Yeah, I would say so. We don't do too much in the wholesale space. We had previously stayed away from things like insurance and investment as well, because again, we built the business to serve customers in areas that we knew. We didn't know those areas before. So when we acquired Medius, we brought on a new skill set to serve insurance, investment, etc. We now could serve wholesale, but we just haven't done any work there really. It's been mostly retail.
Yeah, and I remember a few years ago the FCA struggling to deal with platforms and whether ranking things by alphabetical order was actually advice or not, and all of that back in 2017, 2018. How do you feel that they've understood some of the more radical profiling that can now be done with AI, pattern matching, and that sort of thing? Do you think that the regulator is coming along to automating that stuff, or do you think they're still struggling with, well, you're giving advice there, so you need to have a different regulatory framework?
Well, I think when we're talking about the advent of brand new technologies like AI, the FCA is certainly on a learning curve. They've got some very good individuals there that understand it quite well. Also, some individuals that don't understand it particularly well. And so when they're then determining how prior concepts like information bias, advice versus non-advice, how that interrelates to the AI processes themselves becomes quite a complex determination. And so I think they're still on that learning curve, frankly, and I think they will be for quite some time. But also, the general regulatory environment across the world is on quite some learning curve about AI and how that all gets deployed through different industries. Financial services, though, I suspect will be on a learning curve for significantly longer.
I don't agree with AI in financial services. Personally, I don't think you can tie responsibility to it. And for me, a key precept of the regulations is responsibility. There is an individual within an organization that is either the top of the tree or bears responsibility for whatever goes on within the environment. And I have a fear that people will start saying, well, it was the AI, we don't understand it. And I think the regulators have a real issue with opening the AI door in financial services without having thought through the responsibility matrix. And I know that we had a chat the other day and you had some interesting ideas about head of AI or something. I can't recall. What was that? Your idea was that there was some regulatory position that basically went to jail if the AI went rogue.
Exactly that, right? You made the point that how do you hold AI accountable for when things go wrong? And the frank answer is that you can't. And so I think what you see is something similar through the SMCR framework around an accountable individual for the deployment of any and all AI technology, so that there is somebody accountable, and you don't just have an excitable co-founding team trying to deploy AI any and all ways that they can to disrupt the industry. At the end of the day, the market needs to maintain its integrity. It needs to be competitive, but ultimately it needs to work for consumers. And it's not going to work for consumers if you have a random AI that's completely unsupervised, operating a large proportion of financial services, right? So somebody needs to be accountable for it. The question is who and how, and of course you would need somebody appropriately senior and skilled. You can't just have somebody who's been dabbling on ChatGPT for the last 3 months or so, whatever, as your let's say chief AI officer, or whatever the title could be. It needs to be somebody who truly understands the AI models that are out there, why their particular model might be working one way or another. Where it's non-deterministic, I think there's always going to be a very difficult conversation with a regulator. But of course, if the regulator are not geared up technically to understand those answers, it's going to be as much as talking to a brick wall, essentially. So we're going to need to have the skills and expertise on both sides in order to make sure it's regulated. I also think the FCA will probably keep their powder relatively dry until the more global AI regulation develops. Of course, we're starting to see those conversations happening now. I always think it's quite interesting that now that OpenAI have a significant foothold in the market, for example, they're suddenly now lobbying the global governments to create the regulation. Seems to me like they're artificially creating an economic moat for themselves. But there does need to be some level of control around the world in terms of how AI is created, developed, supervised, particularly how it's trained as well. Of course, if you are censoring and making inherent biases towards the learning models, the outputs as well will be significantly affected. We saw that with Google's debacle when they put out their most recent tool. Well, not most recent now, but the prime model, let's say. So it's really, really difficult. Who's behind everything? How is it going to be regulated globally? It's something that we're, of course, staying very, very close to and trying to make sure that we understand all of the goings on.
So we're saying we need something like Sysgate, the outsourcing rules for AI, because Sysgate says you can outsource the delivery but not the responsibility, but you as a firm need to retain the competence and experience to manage anything you outsource. So effectively, you outsource your back office, you should retain the skills in-house to check and balance what the back office is doing, because you retain the responsibility for their deliverable. So we're looking at something like Sysgate, but for AI, where there is the responsibility is still on the firm, even though they've outsourced it, because a lot of AI will be vendor provided, not internal provided. I get in fintech, yeah, it's an AI play with a bit of finance tacked on, but for most people in our market where we do email review, some people are all about AI in this will reduce your false positives guff that they bomb on about forever and ever. They say, oh, we'll train an AI to do it. Great. So what are you missing? What's the AI? Because it's non-deterministic, same data in, different data out. They're not going to give up what their AI is to anybody, right? It's their secret source. Yeah, they've ripped off ChatGPT or whatever it is, but it's their secret source. So there's not a bat's chance they're telling their customers how the model works. So at what point does the regulator step in and go, unless they're going to be honest, you can't use it? Or chat agents that might give advice. I'm looking for a new mortgage for this X, Y, and Z. Now, I get there'll be fintechs that will be providing these things, but most people will go to a vendor and buy one. And that vendor isn't going to give stuff up.
Yeah, I think you're right, James. I think you're right. I think development of proprietary AI will be reserved for all but the largest institutions in the world with the capital and the data available and the skills available to build something. I suspect the majority of the market that integrate AI into some or more, all of their processes will be using external vendors. I think the idea of something like Sysgate is a good one. You must do your own due diligence and confirm that it makes sense. Of course, we have various regulation around third-party risk management, supply chain evaluation, those types of things. And I think if you're an accountable person, your chief AI officer or whatever we call them, I quite like that name. If they don't understand the supply chain, the vendor, what that technology is doing, where they might be getting any additional services from. So of course, we're seeing a lot of things now that we're hearing is kind of pioneering AI, but it's not really. It's instructions over the top of ChatGPT. And so you kind of go down this line to understand where actually is the AI sitting. If you don't understand those things, you're in very hot water. It's much like, I think, existing vendor management services now, where it's not enough to say you've got PEPs and sanctions screening, for example. You need to know why that's reliable. How can you be sure that the PEPs and sanctions screening tool is operating effectively? How do you have assurance that the technology is operating as you expect it to, but also that all of the underlying data makes sense and is reliable? How do you know that all of the parameters are configured correctly? And of course, a lot of this sits generally with a money laundering reporting officer, and they will be reliant on their team being able to explain how it all works. They won't necessarily know all of those details to the nth degree themselves, just by way of their day-to-day role, but they will need to know that the systems and controls are configured appropriately. I think we see something similar with AI, but the technological knowledge is obviously significantly higher in order to do that role effectively.
I also think that we don't help ourselves by calling it AI, because we lump a load of stuff in there. There's the generative AI, large language model, made stuff up, bunch of if statements. And then there's genuinely cool stuff like natural language processing, anomaly detection, and machine learning, all of which is lumped into AI, but is deterministic. You put the same things in, you get the same things out. And I think when people say AI at the minute, it's a shorthand for ChatGPT, whereas actually some really neat pattern recognition technologies that we use for market supervision in terms of are people insider trading or slamming the close or whatever, that's genius stuff and utterly deterministic, because you're creating a profile and it's acting out a profile. That's cool. I think lumping that into AI is not doing the market a service, because it's not really AI, it's clever maths, whereas ChatGPT is just rubbish for any form of regulatory service whatsoever, because it makes stuff up. It's not deterministic, and I don't think it has a place. Anyway, that's my rant on AI. Don't like it.
I'm sure the audience enjoy hearing the rants, James. But I think you make a really important point, though, which is the kind of abuse of terms, let's say, because when you talk about AI now, most people do immediately think ChatGPT 4, right? And that's about the extent of what they associate AI to be. People who are closer to the space understand that it's much wider than that, but there's still a small cohort of people that understand the genuine difference between something like robotic process automation and AI itself. Of course, those two things technically are entirely different, but the mass market, let's say, assume that they are one in the same, and that's not fair to do. And so if that's the case for most people, you can imagine how that plays out with the financial services individual wanting to deploy AI and the regulator themselves. I can imagine now having a technical conversation about why something is or is not AI, and therefore should or shouldn't be in scope of some regulation or another, could be a real challenge, because you're going to have to educate. But that I think is a general information bias challenge. We have that every day. Providing financial services to consumers, they might think that they're getting one thing, but they're actually getting something entirely different.
I'm moving on slightly from this, because we could talk about AI all day and everybody will tune out. A lot of move fast and break things type people is all about getting their model into the market to see if it's working or not. Where do you stand on the regulatory hosting stroke principal model in RegTech, FinTech as a speed to market issue?
Well, I think it does. It does provide great speed to market. I think when we're talking to new clients and they're considering, should I apply directly or should I work through a principal firm? What should be my process for getting the, let's say, the legal ability to provide financial services? Generally, it is always faster to go the route of an AR or something similar to that. The challenge, of course, is that whilst you get to market faster, you are bound by the standards of that firm themselves. And so if you want to put out a financial promotion, it's got to go through their compliance team. And if their compliance team do not like it, well, guess what? You can't put it out, or you'll need to change it in the way that they say. And so if they're not happy with your regulatory disclaimer, for example, and they think it needs to be, 6 lines long and not 1, and your designer is saying, well, that's going to look horrendous, you're bound by that. You can't do anything about it. You're using their license. They have the regulatory exposure. And so basically suck it up. There's not much else you can do. For the principal firm themselves, of course, they are essentially a gateway to financial services. They're allowing the ability to use their license to provide financial services, and therefore they don't have to go through the same scrutiny of the FCA that they ordinarily would do. But all that risk is on your shoulders. And so if you don't really understand what they're doing, if you don't really understand their controls, you are significantly exposed yourself. And we are right now, I can't say too much, but working with one of the major players in this space to remediate all of those systems and controls, because of course in the past they hadn't supervised people that wanted to become their customers and use their license as much as they should have done. And then years down the line, they identify significant risk. The FCA identifies significant risk. And you see this in the market. The FCA is starting now to take a very close look at other providers. And it's a bit of an output, I think, from their thematic review. They took a look at it and decided we really don't like the noises coming from this sector. Actually, we think it's ill supervised, and we're not happy with that. But it is a trade-off against having to go through the process of holding with bated breath that you will get a good FCA case officer that's willing and understanding of your business model and will ask good questions, not just questions to delay the timer on their side. You can avoid all of that with the principal model.
And if a fintech came to you and said, look, just want to try this, do you mentally have a set of reg hosts that you go, okay, these guys will understand it? Or are you struggling to find a reg host that understands the retail aspect? Because there are bucket loads of them in wholesale, very few of them in retail.
Yeah, well, I think, in retail, of course, the regulatory burden is a lot higher by nature of the consumer-focused risks. In terms of clients and how we engage with them, there's a few things I would start with before I got to the point of recommending some form of regulatory host or principal. The first thing is, do we actually want to help them? Because Edmund has set itself out as a player in the market that doesn't help any and all people. It helps the people that are serious about their regulatory journey. There's plenty of fintechs out there that are willing to splash cash, but really don't want to use your advice and don't want to use the things that you create for them. We're not interested in working with them people. Mm-hmm. And we'll assess that through our initial conversations. What is their attitude towards compliance? How willing and able are they to listen to what we're telling them and guiding them on? If the answer to that is yes, they seem serious, then the next question is about, well, what is appropriate for them in terms of regulatory permission? Because, of course, the traditional process does take longer and cost more money. But sometimes it's right for them because they need the autonomy of their own license. They need the accountability of being directly authorized and responsible for their own affairs. But where it gets to the point of they definitely want to be some form of AR, they want to be an agent or a distributor of a larger platform, then we don't at the moment typically recommend who they should work with, because there's so many different players in the market that have different they have different, let's say, strengths and weaknesses. Some have really good underlying banking tech, so that you don't have to build it all yourselves, but not necessarily the strategic guidance to help you get to where you want to get to. Other ones have very good compliance departments and can help you navigate what you're trying to achieve through the regulations that exist, and they're willing to work with you. But it's quite difficult, I would say, to recommend in that space. We do a lot. We have a lot of strategic partnerships around vendor services, systems, and controls. And so, if we have a client with no transaction monitoring tool or a very weak transaction monitoring tool, we have a number of partners in the market that have very good and very different offerings, and we can right size those, but not necessarily on the application side.
And talking about client engagements, it's difficult as a consultant, right? You're perpetually selling in, trying to find new clients, the rest of it. How do you see the market going in generating annuity revenue from some of the clients you're working with?
Well, that is, as CEO, I suppose that's my inherent and most concerned question that happens constantly. Because for me, for example, if we were to ever seek to exit Edmund Group, or if we wanted to raise funds or anything like that, the traditional revenue model of just doing a project, delivering a project, and then that's it, doesn't actually work out that well for business valuation methodology. It's not a particularly attractive business, frankly, because it relies on you as founders. And so for us, it's a question that we've been batting around from day one, and will, I'm sure, battle around forever. What we do, though, is we do quite a lot of business on recurring fees basis. And so some of our larger clients, for example, pay a fairly simple fixed retainer fee, and we are simply there for them whenever they need it and whatever they need. Now, we work with them to try to understand what that looks like, because we don't feel comfortable being paid, for example, a huge retainer when the client only needs us for half a day a month or something like that. That doesn't make any sense at all for them financially. And so we would typically look at that engagement and understand, well, they've used half a day, we'll just work with them on what is known as time and materials basis, because it's best and most flexible for them. We have other clients who genuinely have quite a volatile need for advisory. Sometimes it's very, very high, sometimes it's very, very low. There's things in compliance, there's things in risk, there's things in financial crime. And of course, a traditional consultancy will issue new statements of work for every single one of those things. It's an administrative nightmare. For us, we just work on a single fee, and we'll work with them whenever they need it. And sometimes they might need us more than they're technically paying for. Other times they might need us less, but it kind of works out over time. And this is what we call Edmund as a service. So essentially we are there almost at your beck and call for whatever you need, whenever you need it. And sometimes what we'll do is a little bit of a pilot process as well. So we're with a client right now who said, look, we know we need the expertise and the capacity. We don't really know for sure what we need in terms of time, whether it's hours, days, or weeks, and we don't really know if we want to stay in one particular sphere of expertise like financial crime, or if we want to use multiple expertise. And so we just set up an initial pilot program to say, look, we'll work together for a month. We'll test, monitor, and learn what you need, and then we'll put together a more accurate model for you.
Right. And which business lines are you selling into Edmund as a service? Do you have specific practice areas that you say, this is our expertise in risk and compliance, this is our expertise in fin crime? How do you present yourself outwards?
Well, by nature of how we've set ourselves up as a company, our limitations are more around the verticals of financial services in our experience there than it is around our GRC expertise. So we've hired people who have done compliance 360 pretty much. So everything from application all the way through to assurance, monitoring programs, policy writing. We've done the same in risk management and the same in financial crime. And so if you're talking to us about KYC or transaction monitoring or business-wide risk assessments, there's always somebody there that knows those things. So across GRC, we're incredibly well serviced. It's really the market sectors ourselves that we would say, look, we haven't worked in this space before, and so we wouldn't want to advise you on that particular nature of business. And so Up until last year or so, when we acquired Medius, the standouts were always things like we won't touch insurance because our team have not worked in insurance before. We wouldn't touch investment or capital or anything like that because we haven't worked in those spaces before and didn't really understand market abuse, etc. But now that we've acquired those skill sets, we can serve them. And so when we're pitching Edmund as a service, let's say, we're essentially saying, look, imagine you've got an additional compliance officer, compliance manager at your disposal. You're going to be asking them to do a certain set of deliverables, let's say, that you've agreed with the board. Consider us that outsourced resource to you. We can help to advise you on those things. We can review things. We can build things for you. And so it makes their lives a lot easier.
And you had a really nice 6 eyes process where you were talking about the person doing it, the partner, the other part. How does that work for your clients as you're putting things through?
Yeah, so in terms of when we're actually doing something for somebody, you will, of course, have a point of contact at Edmund who is an expert in their own right and delivering that piece of work for you. So if somebody is doing a business-wide risk assessment for you, they will understand you and your business model perfectly. They'll deliver the business-wide risk assessment, but in all cases, it will also go through the team lead of that particular project. And usually that is somebody at partner level. And then all work is also checked and signed off by an independent partner as well. And so if, James, you were our client, for example, asking for that business-wide risk assessment, it would have been done by an expert. It would have been checked by perhaps, let's say, me as the most senior subject matter expert in financial crime on our team. But then it will also be reviewed and checked by another partner who is completely independent from the project, which makes sure that I'm held to account. They have no vested interest in doing anything other than making sure that the output is right for you.
That's pretty cool. And how are you going to go about scaling that? Because as you grow and get more clients, how do you see the automation that you will be putting in place will develop?
That's a really good question. Again, services-based business models are inherently difficult to scale. Usually it looks something along the lines of, we're working with a new client and now we need to hire somebody new to do that work. That's a strategic challenge that's really, really hard to break the back of. Internally, we're trying to stay incredibly lean on our processes, on our systems and controls. And so we're not, for example, we're not doing a lot of the manual and laborious tasks that exist in other businesses. We try to use things like robotic process automation, for example, to move workflows along quicker and not rely on a human to, complete a follow-up task. It might be, for example, if we've had a meeting and all of the notes have been typed up and sent across to you, somebody needs to remember in a couple of days to check back in with you, right? And that can lead to just artificial and irrelevant delays. That's all automated for us. And so it's a case of trying to build our processes, systems, and tools in a way that work faster for us, reduce the risk of manual error or human delay. And of course, we've talked a lot about AI. For us, we see that as a potential existential threat and a potential significant opportunity. So we're looking at that particularly closely. That's not necessarily saying that we will create the first AI-based consultant, because I think technology, the world's environment, the regulation, we're probably quite some time away from that. But starting to use AI in different processes is important that we start to look at, because if market sentiment turns that way, even if we don't agree with it, we're still stuck in the mud, right? So I think it's a little bit adapt or die for us over the kind of medium to longer term.
And how have you found tooling up to deliver correctly? Because one of the struggles that I have is there's just a dozen different tools you can use to do any particular job, and which CRM, which workflow, which intranet, blah, blah, blah. Everything's got a strength and a weakness. How have you got through that morass of vendor nightmare to pick a decent tool set to base the business on?
Well, we in most cases, we try not to commit to long-term fees. So, for example, if it's a 2 to 3 year license fee, we don't really have the ability to test the system. We're just tied for a long term, and whether it's good, bad, or ugly. And we try not to get too emotionally attached to tools, right? I think some people internally can procure a vendor or make their own tool, and suddenly it becomes their baby, and anybody who says that it's ineffective is on the opposite side. For us, we're willing to test and learn very, very quickly, and particularly our project management tools, things that we use to take count of our timesheets and set out our deliverables to clients. We've been through probably 4 or 5 of those in the last 5 years. Each one of them had something that didn't quite work for us. And so, we've eventually settled on one now, but we've had to test and learn and be agile. And of course, we have to make sure all of that's entirely invisible to our client.
Yeah. And in terms of recruitment and hires, you're a people business. How are you assessing people that you come across to make sure they're keeping the quality standard that you have on offer to your clients?
A great question. I mean, one of our core values, of course, is making sure that clients get the quality that they deserve, and that we have hired people that understand them and their needs. The first port of call really is that we work with recruiters who we've worked with in the past. So, of course, when I was a head of compliance, money laundering reporting officer, etc., I would work with certain people to help me find jobs, people that I learned to trust. So, I'm going to miss names, but just to throw a couple out there, for example, Dominic Waterhouse-Kern, Will Pedley, those are recruiters who we know the market very, very well. They're very strong in fintech. They know very good people in those markets that work on the other side, the client side for us. And so we typically partner with them to first source the talent. Once we start to go through the recruitment process, of course, we set up quite a lot of technical questions, personality fit questions. First and foremost, we need to make sure that they can operate well in our environment and with our team. Edmund is a business that operates, as you'd probably expect. We expect our employees to be adults. They know what work they need to do. They know what our clients expect. Everything else is down to them. So when they clock on, when they clock off, it's down to them. When they take holiday, it's down to them. They've got a sense of freedom and autonomy, right? But it takes a certain type of person to operate in that environment and not abuse it. And so, we make sure that there's a good culture fit, a good values fit, and then a good technical fit.
Perfect. We're coming up on the hour now, where people will drop off and go on to do the next thing. Just to wrap up, where do you see the market going in the next 12 months? Regulation, client thrust, that sort of thing. What's your 24-25 outlook?
Well, I think as we see more VC funding opening up again for financial services, particularly with AI and financial services together, we're going to see a lot of people coming to market in those spaces with good ideas. Some of them good ideas, but very challenging to practically implement. So I think that will be very, very high. I think we'll start to see more and more around the regulation of AI and the risks, particularly around deploying it, especially in our sector. I think consumer duty is going to become a pain in a lot of people's backsides, because the FCA are now expecting people to have their affairs in order, and a lot of them still don't. And some of them have treated consumer duty as a point in time thing. So they did it at a point in time, and that's it. They're not taking it as a continuous part of their business model, which of course is actually the expectation. So I think we'll see all of those themes coming to light.
Very good. Brilliant. Thank you very much for the past hour. That's been absolutely fascinating. If people want to get in touch with you, how do they do that? You're on LinkedIn, website?
Yeah, so on LinkedIn, J Deeks, you'll find me on LinkedIn that way. Type in my name as well. I think I'm the top on that search, so you can get in touch with me that way. You can email me directly, jdeeks@edmund.pro, or our website is edmund.pro. So you can visit us on the website and submit an inquiry there, and one of the team will be in touch.
Perfect. It remains to say thank you very much. And we will see you on the next compliance catch-up.
Thanks, James.